Christiaan Kraan is the head of investment specialists at Seeyond. Currently, he heads a team of investment specialists and product managers dedicated to Seeyond, the structured product and volatility management investment division of Naxos Asset Management. Why should someone invest in volatility? How different is this asset class compared to the usual asset classes? And how does this asset class complement the usual equity or bond asset classes?
Well, I think the way it compares to the usual bond and equity asset class is actually the reason you should invest in it. Okay, equity volatility is a great diversifier in an equity bond portfolio. If you look at equities, okay, when equities go down, equity volatility goes up. Okay, since equity volatility is investable as an asset class and it's liquid, you can have a nice diversifier in there. On top of that, very recent, if you look over the last years, equity and bonds have started correlating more and more, and actually a lot of the equity volatility we've seen in September now is actually linked to fixed income or interest rate increases. So look at your traditional equity bond portfolio of your traditional investor. What is basically going to diversify? What is going to be a diversifying factor for your investor over the next couple of years if both equity and bonds are recorrelating and you're heading into kind of a systemic crisis? That's where equity volatility can have a very nice function of kind of protecting against major drawdowns.
How should someone invest in a volatility fund? Should he buy and hold? And what percentage of a portfolio should be allocated to it?
So there is, when you maybe take a step back, when you invest in volatility, you can either buy volatility, or you can sell it. It's a binary trade. And what the volatility fund does is manage that actively. Okay, so it manages actively the exposure to volatility. And what we've kind of designed it for is for your traditional equity investor to provide a level of protection, okay, during systemic crisis, but and low. Kind of slightly above zero returns during normal times. But I believe that an equity investor, or an investor should allocate about 10% of its equity allocation to a fund for it to have material impacts. Okay, you're looking at something that's been designed to generate, below 0 to 4%, below 4% during normal environments, and then up to 15% during a systemic crisis. So if you want to have some impact of that onto your portfolio, you should hold at least 10%, I guess. Okay, so you're not looking at high returns, so you don't want to allocate too much because it's going to draw from your equity returns. Okay, but you should hold a little bit of it to basically protect your allocation against future drawdowns.
What instruments does the fund use to invest in volatility?
Okay. So it's very important when you manage a volatility fund, you're basically managing a fund for days where you have great market distress. Okay, so it's very important that you're very cognizant about the risk. You don't want to add any other risks than volatility risks. So what we have in the fund actually is just very safe fixed income instruments that serve for collateral and margin calls, and then we take exposure to volatility through VIX futures, okay, in which you can basically buy and sell volatility, or we can replicate it through equity options and equity futures. But all of these instruments are centrally cleared. Okay, you don't want to have any counterparty risk in your portfolio either, because it's during times of market distress that these materialize. Okay, so you want to make sure that the only risk that you have in your portfolio is volatility risk, because that's the risk that you want to be exposed to.
And which market volatility is the fund trying to capture?
We invest both in, so we diversify between European volatility and US volatility. So basically the S&P 500 and the Euro stocks. We've been looking in the past also to if we could invest into Asian volatility, for instance, to have a more global portfolio. But one of the components which is very important is the liquidity, and we don't see as much liquidity yet in the Asian option and futures markets, and not exactly the same behavior either as we have in Europe and the US. So that's why we've limited to those kind of two core markets. What we're protecting against is a systemic crisis that would affect all regions across the globe, and we want to make sure that when we need to protect an investor's allocation, we want to make sure that there's enough liquidity to be able to execute.
Does it involve leveraging? And what are the risks involved?
if you think about leverage, it's a bit different in this case, okay? Because you're not taking exposure to a market, okay? You're not taking exposure to equity or bonds. So it's not a question of leveraging something. You're taking exposure to volatility. So, and the way that we think about it in what we call Vega. Vega. So it sounds complicated. It's very simple, okay? It's just that our fund will take. Well, you know, if you think about Vega, volatility goes up by 1. Okay, our fund, the fund performance will go up by 1%. Okay, that's how we take exposure. So it's not leverage as per se, but it's more kind of taking exposure to volatility. Okay, and then the rest of the fund is just basically in fixed income. Okay, because we're taking exposure to listed contracts basically. We purposely don't add any other risks into there. Okay, even in a very low interest rate environment, we invest in in kind of very safe fixed income funds. We don't want to have any other returns, but there is of course a risk of timing. Okay, the people that start holding a volatility fund just before a systemic crisis, they will benefit from their protection. Whereas if you buy just coming out of a crisis, which a lot of people did after the last crisis in 2011, you'll have a number of years where a volatility fund doesn't return that much. You know, just keep in mind we're looking at returning low returns during a normalized environment. Okay, and we're looking at providing protection. It's like an insurance, basically, protection. Like the way it works in insurance, but you want to protect during a major market crisis.
What is the current view on market volatility, and how is the fund positioned to capture the upside?
Okay, so we're looking at, and especially post-Brexit today, but we're looking at an environment where we believe that there's a lot of risk in the market that people don't take account for. You know, if you look at Brexit, there was a huge drawdown. Our volatility fund had a big performance on that day, and since we've had this massive market rally, without taking account all the risks that we have in the market. Okay, we still have basically Brexit coming up. Okay, it's going to happen. We have enormous political risks in Europe. Okay, German election, French election, Italian referendum. We've got the U.S. economy, which is at the end of its cycle. We've got U.S. election. We've got Japan, who's struggling with its monetary policy, and we've got emerging kind of environments that need to reinvent themselves. So there's a lot of systemic risk in the market, which we don't see. If you look at this summer, we've had over 40 days of the S&P 500 with less than 1% movements. Okay, so and clearly this is not illustrative of the environment that we're in. There's a lot of political risk. So our exposure at the moment is that we have a long volatility exposure. Okay, we want to make sure that if something breaks down, be it in November, be it a little bit later, we basically hold our contract and then we help our allocators in protecting a portfolio.
Thank you for your insights today. For more information, please visit our website at poems.com.sg/unittrust or talk to us at 653 11555.